Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. When ESPN partnered with Penn Entertainment to get into the gambling business, I think it took a lot of us by surprise. Disney, which is the majority owner of ESPN, has tried to keep a pristine relationship. They were likely a party to Penn Entertainment getting rid of Barstool Sports as part of their agreement. I do think it's really interesting from ESPN's perspective that they're going all in on the gambling business and taking a big check to do that. So today I want to cover why that might be the case and what ESPN might be doing with this money going forward. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I want to just talk quickly about how much money ESPN is getting from this deal. This is the transaction details, and the two things to highlight are the $1.5 billion in cash over the 10-year term of the marketing, services and brands and other rights deal, and then the warrants on Penn Entertainment stock that ESPN also gets. Those warrants are right here. You can see that there are 3 tranches, 30 million shares of stock potentially that ESPN could get if these warrants are in the money. And then there are performance warrants. So basically, if Penn Entertainment takes a more than 20% market share in the online betting space, ESPN starts to get warrants from that as well. So the upside for ESPN, $150 million in cash coming in per year, and they get the potential upside if this partnership is successful with Penn Entertainment by getting potentially 35 million shares of stock at a fairly attractive price. This is actually a little bit below Penn's current stock price today at $27.59 per share. So a lot of upside here for ESPN. So why would ESPN need to do this? Well, I think there's a few things going on. One, we know that people continue to cut the cord. One of the big ways that ESPN makes money is the fees that it charges cable operators to deliver ESPN and Disney's other networks through the cable line. When people cut cable, that fee goes down. ESPN makes less money. If fewer people have ESPN, companies are going to pay less to advertise on ESPN. So it's kind of a double whammy for ESPN when people are cutting cable. At the same time, we're having rights deals come up, particularly the NBA deal is going to be negotiated over about the next year. And that could potentially be billions in additional cost for ESPN. And there's a lot of uncertainty about what exactly that's going to look like. Right now, they partner with TNT, but Bob Iger and others have talked about the fact that streaming rights are going to have to be included in that deal. So potentially the NBA is going to be a much bigger piece of both the cost pie and the distribution pie for ESPN. We also know that Iger has talked about ESPN going over the top. So basically you can have a subscription to ESPN. This won't just be ESPN Plus. It will be actual ESPN that you can get as a streaming service. If we get content like the NBA on a streaming service like ESPN, that could be a massive cost for ESPN and Disney, although there's a lot of upside there as well. So how do you pay for content like that? Well, one way to do that is take a big check from Penn Entertainment to be able to start paying these rights deals. I think that's one of the ways to think about this is as ESPN starts to have to pay for content and starts to build its own streaming service that is outside of the typical cable bundle, how are they going to monetize that? And this is one of the ways they're going to monetize it. They're going to take sponsorship deals from companies like Penn Entertainment. They're going to look at advertising, both brand advertising and direct advertising. They're going to look at bundling with Disney Plus and Hulu. There's a lot of ways you can monetize it, but you need to grow that service. You need to have content there, and you need to have money coming in the door because the cable business is not nearly as profitable as it used to be. All of these dynamics play out in the fact that ESPN needs money. Penn Entertainment needs to grow and be more relevant in the online gambling space, the online sports books. That's why they're willing to pay ESPN to be their partner. And now ESPN has a little extra juice to go after more content rights. What exactly they do with that, what exactly the over-the-top service looks like, we don't quite know yet. But I think that's strategically what ESPN and Disney are thinking about. We will learn more over the next few months and the next year, especially with this NBA deal. So watch that one. But it's going to be fascinating to see what ESPN looks like a year from now. What do you think about this deal, especially from ESPN's perspective? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.